Welcome back to the deep dive. Today we are opening up a file that, I have to be honest with you, usually makes my eyes glaze over about 3 seconds after I read the title.
Oh, I guess.
We are talking about the thrilling, the exhilarating, the edge-of-your-seat world of budgeting and cash flow management.
It's funny you say that. It's the vegetables of the financial world. Everyone knows they need to eat them. Nobody really wants to. Everyone thinks they're cooking them wrong, and yet it's the only thing keeping the whole system healthy.
Exactly. I feel like budgeting is that thing we all pretend to do. We nod solemnly when our accountant mentions it, but secretly we just look at our bank balance on the app, see if the number is green or red, and hope for the best.
Right. Hope is not a strategy.
It is not. But we have a very specific mission today. We are continuing our journey through the NISM Series XA certification. This is for the investment advisor, level 1 exam. And specifically, we are diving into Chapter 3, evaluating the financial position of clients.
That's right. And listen, I know you think this is boring. I hear it all the time from candidates. But here is the hook. And you need to internalize this for the exam and for practice. Cash flow mismanagement is the #1 reason financial plans fail.
The #1 reason, really?
Absolutely. You can pick the best stocks, the best mutual funds, have the perfect asset allocation. But if the client, or you, can't manage the inflow and outflow of cash on a monthly basis, none of that matters.
Why not?
Because you will never reach those long-term goals. You'll be forced to liquidate your assets at the worst possible time just to pay the electricity bill.
Okay, that actually does raise the stakes a bit. It's the foundation. If the foundation cracks, the house falls down, no matter how pretty the house is.
Precisely.
So, for today's deep dive, I am playing the role of the student. I'm the one prepping for the exam. I've got my highlighter out, and I'm trying to keep all these definitions straight because, honestly, there are some tricky ones here.
There are.
And you are the mentor. I want you to treat this like a Zero the Varsity module, detailed, practical, and hyper-focused on what we need to know to pass this exam.
My goal is that by the end of this, you won't even need to read Chapter 3 of the PDF. We're going to cover every definition, every formula, and every single list in the text.
Perfect. Let's look at the roadmap then. We are going to move strictly chronologically, just like the textbook. We'll start with the philosophy of cash flow in section 3.1.
The why.
The why. Then we'll move into how to actually build a budget and the specific hierarchy of expenses. After that, it's the mechanics, inflows, outflows, forecasting. And then, and this is the part that scares me a little, we are going to end with the math. Section 3.9 is all about financial ratios.
Don't worry about the math. I promise by the time we get there, we'll have built up so much context that it'll all make perfect sense. It's just logic with numbers attached.
All right, I'm trusting you on this. Let's jump in. Section 3.1, the importance of cash flow management. To me, personal finance is just make money, spend less than you make. Is it really more complicated than that?
Fundamentally, no, that's the core of it. But operationally, yes, it's way more complicated. The core concept, as the text says, is managing surplus.
Surplus.
You want your income to be greater than your expenses. That difference is your surplus, or your savings, which you then allocate to future goals. That's the easy part. But here is where it gets tricky, and this is what the text really emphasizes. It's not just about the amount of money, it's about the timing.
The timing? You mean like when the money actually hits the account?
Precisely. The text calls this the starting point of the whole personal finance process. Imagine a salaried individual. Their expenses, rent, electricity, telephone bills, paying the household staff, the mortgage EMI, those are all due on specific dates, usually early in the month, let's say the 1st through the 5th.
Yeah, that sounds about right.
But what if your income is irregular?
Like a freelancer, maybe, or a small business owner.
Yeah. Exactly. Or even a salaried person who relies heavily on, say, quarterly bonuses or reimbursements to make ends meet. If there's a mismatch, say the bills are due on the 5th, but the big client payment doesn't hit the account until the 15th, you have a legitimate problem.
Okay.
Even if you technically earn enough money over the course of the year, that 10-day mismatch forces you into a cash crunch right now.
So you have to swipe a credit card or maybe borrow from a friend just to bridge that 10-day gap.
Correct. And that debt comes with interest. That interest is an extra outgo or expense which you wouldn't have had if the timing had just aligned. So a simple timing mismatch literally makes you poorer. The text is very clear on this. I'm quoting here. There has to be adequate income coming in at all points of time so that a surplus is generated. It's not enough to be rich on paper. You have to be liquid in reality.
It's interesting because the text also goes into the psychological side of this. I found that really surprising for a finance textbook. Usually they don't care about feelings.
It is surprisingly empathetic, isn't it? It explicitly lists tension, disruption of normal life, and disruption of family peace. It says if this kind of cash crunch persists, it leads to health problems.
That's very real. Money stress is toxic.
It is. So when we talk about cash flow management, the key word the text wants you to remember, and flag this for the exam, is empowerment.
Empowerment. How so?
Yes. Good cash flow management gives the client control. It gives them the confidence that things are being handled. It's not just about numbers on a spreadsheet. It's about the smooth running of the household. It allows you to make decisions from a place of calm rather than a place of panic.
That's a great framing. It's about buying peace of mind, not just managing money.
You've got it.
Okay, so step one is admitting that timing matters as much as the amount. Step two, I guess, is actually doing the work. This brings us to section 3.2, preparing the household budget.
Right. And this is a core role of the investment advisor. Your job isn't just to pick stocks. You are there to help the client understand the sources and applications of their funds. You're essentially an auditor for their life.
The text has this table 3.1, which is a sample household budget for the ABC family. For our listeners, I want you to visualize a spreadsheet. It's got three main blocks. Top block is income, middle block is expenses, and the bottom block is savings.
Okay, let's break down that top block first. Income. The text is very specific here. You need to distinguish between things like gross salary and income from investment.
Why does that distinction matter so much? I mean, money is money, right? If I get 5,000 rupees from a dividend or 5,000 from my boss, it spends the same.
It spends the same, but it doesn't arrive the same. And that goes back to our timing issue. Your gross salary is usually regular, predictable. It comes on the same day every month.
Okay.
But investment income like dividends or capital gains, that might be infrequent or variable. You can't plan your monthly grocery bill based on a stock dividend that might come in June.
Ah, I see.
You need to segregate stable income from variable income to build a robust, reliable budget. If you rely on variable income for your fixed expenses, you are basically just walking into a trap.
Got it. That makes perfect sense. Now let's look at that middle block. Expenses. This is where I feel most people, myself included, mess up. We just list spending as one big lump sum, but the text has a really strict hierarchy here.
It does. And you need to know this order for the exam because it dictates all the decision-making later on. There are three categories. First, and most important, we have mandatory expenses.
How are we defining mandatory? Is it just things I really, really need?
No, it's actually stricter than that.
Yeah.
These are compulsory. You have absolutely no choice. If you don't pay these, you face legal action or very severe financial consequences.
Okay, give me some examples.
Taxes. You can't skip paying the government. EPF contributions, your Provident Fund, those are deducted before you even see the money. And crucially, loan repayments, your EMIs. If you miss your EMI, the bank comes after you, your credit score tanks, and you could literally lose the asset, like your house or your car.
Okay, so that's the must pay or go to jail lose your house bucket. What's the second category?
The second category is essential living expenses. These are necessary for daily survival and maintaining your current standard of living.
So, groceries.
Groceries, education fees for the kids, utilities like electricity and water, transportation to work. You can technically survive without paying the electricity bill for a few days, but your life pretty much grinds to a halt.
Yeah, no kidding. And the third category?
Discretionary expenses. These are the wants. Entertainment, lifestyle expenses, eating out at fancy restaurants, vacations, subscriptions you don't even use. The text makes a key point here. This is the first category that has to be cut if there is a need to control spending.
That seems obvious, but in practice, I think it's hard. People often cut their savings before they cut their lifestyle.
Exactly. And that's precisely why this hierarchy exists. It's a tool to remind the advisor, and for the advisor to remind the client. Savings are essential for your future. That fancy restaurant is discretionary. If you are cutting your SIP to pay for Netflix, you have the hierarchy completely wrong.
Okay, now I want to flag something that confused me a little bit in the text. It's about how we calculate savings.
Ah, yes. This is a classic exam trap. I see people get this wrong on practice tests all the time. Let's unpack this very carefully.
So my natural instinct is income minus expenses equals savings. Whatever is left in my bank account at the end of the month is what I saved.
And that is technically incorrect in the context of a comprehensive financial plan. The text makes a crucial distinction between monthly surplus in hand and your total savings. They are not the same number.
Okay, walk me through the difference using the numbers from the text's example.
Let's look at the example. Let's say your total income is high, But after all your taxes and spending, your monthly surplus in hand, that's the cash literally sitting in your savings account at the end of the month, is 7,000 rupees.
Okay, 7 grand.
However, usually, before your salary even hits your account, money is deducted for things like the Provident Fund, PF, or the National Pension System, NPS. In the text example, let's say the mandatory PF contribution was 9,000 rupees.
Right, and those are listed under mandatory expenses in the budget we just talked about.
Correct. They are expenses because they reduce your take-home pay. But think about it. Where does that money go? Does it go to a shopkeeper or a restaurant?
No, it goes into my retirement account. It's still mine. It's just locked away for the future.
Exactly. It's not gone like the money you spend on groceries. It is forced savings. So to calculate your actual total savings, you take that monthly surplus in hand, the 7,000, and you have to add back the mandatory savings deductions, the 9,000.
So 7,000 plus 9,000 is 16,000.
Your total savings is actually 16,000 rupees.
Wow, that is a huge difference. 7,000 versus 16,000. If an exam question asks for total savings and I just put down the cash surplus, I'm going to get it wrong.
100%. And in the Indian market context, think of it as the difference between your take-home pay and your CTC, cost of company. Your actual savings rate is often higher than you feel it is because of that forced savings component like EPF.
I see.
An advisor needs to show this to the client to give them a true picture of their wealth accumulation. Frankly, it makes the client feel better, too. They realize they're saving more than they thought.
Okay, that is a solid takeaway. Add back the PF. I've written that down with a star next to it. Let's move to section 3.3, cash inflows and outflows. This section seems to split into two parts, cash management and then the income and expenditure statement.
Correct. Let's start with 3.3.1, cash management. This highlights what I call the paper profit trap.
The paper profit trap, that sounds ominous.
It goes right back to that timing issue we started with. The text introduces us to a character named Sunita. Sunita earns 50,000 rupees a month. On paper, she has a surplus. She's doing well. But 15,000 of that salary comes in the form of reimbursements.
Oh, I hate reimbursements. You have to spend your own money first, file a claim, argue with HR, and then maybe get paid back weeks later.
Exactly. So if Sunita's bills hit on the first of the month, she might not have the cash to pay them, even though she's technically earning 50,000. The full amount hasn't been received yet. This can throw the entire calculation out of control and cause a severe cash crunch.
So she's profitable on paper, but broke in cash.
You've got it. That's the trap.
So what's the solution? The text mentions a separate fund.
Yes, a cash handling fund. Now, please listen very carefully because this is another potential exam trap. This is distinct from an emergency fund.
Wait, really? I thought they were basically the same thing, just a pile of cash for when things go wrong.
No, they serve two very different purposes. An emergency fund is for major disasters, job loss, a medical crisis, a huge unexpected expense. A cash handling fund is strictly for smoothing out these routine monthly timing mismatches.
Okay.
It's a buffer in your checking account to ensure that when the rent check hits, it doesn't bounce, even if your reimbursement from work is 3 days late. It prevents you from having to dip into your real emergency fund for what are essentially routine, predictable issues.
That is a subtle but really important nuance. Don't break the emergency glass for a non-emergency.
Exactly.
Okay, let's look at 3.3.2 then. The income and expenditure statement.
Right. So this statement gives you a view of all your financial flows, but over a specific period like a month or a year. The key concept to understand here is the accrual basis versus the cash basis.
Lay it on me. I know this is where accountants get really excited.
The text uses a credit card example, which is the easiest way to understand it. Suppose you buy a new laptop in January using your credit card. The bill for that laptop is generated in February, and you pay it in February. In your income and expenditure statement for the month of January, do you record that expense?
Well, I didn't actually pay any cash in January. I paid it in February. So on a cash basis, it would be a February expense.
Right. But the text argues for the accrual concept here. The expense was incurred in January. The consumption, the benefit of the laptop, happened in January. The decision to spend was made in January. Therefore, the expenditure statement should record it in January.
And what about income? Same logic.
Same logic. If you get your salary for the work you did in January on the 1st of February, strictly speaking, that income belongs to the January statement because it was earned in January.
Okay, so the income and expenditure statement tries to match the earnings and spending to the actual time they happened, not just when the cash moved hands. Why do we go to all this trouble?
To determine the true extent of surplus or savings generated by your lifestyle during that period. If you just keep pushing all your expenses to next month's credit card bill, it might look like you saved a lot this month, but that's a lie. You're just delaying the pain. Accrual accounting keeps you honest about your actual consumption.
Keeps you honest. I like that. All right, moving on to section 3.4, budgeting and forecasting. We've got a 4-step process for making a budget here. Let's run through them.
It's a very logical flow. Step 1, list your total, regular, and definite income. And the key word there is definite. Don't budget based on a maybe bonus.
Okay.
Step 2, from that income, deduct your mandatory expenses. What's left is your disposable income.
Right.
Step 3, from your disposable income, deduct your essential living expenses.
Groceries, utilities, etc.
And finally, step 4, deduct your discretionary expenses. The result of all that is your savings.
Simple enough. But what if step 2 is too big? What if the mandatory expenses, specifically the loans, are eating up almost all the income?
And that happens often. If those mandatory expenses are too high, the advisor has to perform what the text calls a debt rationalization exercise.
Debt rationalization. What does that involve?
It means you might need to restructure loans, maybe refinance for a lower interest rate, or in extreme cases, you might advise the client to sell an asset to pay them down. Because you can't just cut mandatory expenses like you can with entertainment. You have to change the fundamental structure of the debt itself.
That makes sense. You have to perform surgery, not just put on a bandage.
Well said.
Now, the second half of this section is about forecasting. The text calls it a dynamic exercise. And there are 6 specific rules of forecasting listed. I know we aren't summarizing, so let's hit all 6. I want to know how a financial advisor essentially predicts the future without a crystal ball.
It's less about a crystal ball and more about building a model. So rule 1 is, predict specific future events. You can't just say, expenses will go up. That's useless.
So what's a better way?
You have to say, the child will start college in 2028. Or, the car loan will be paid off in 2026, freeing up that EMI. You have to be specific about the event.
Okay, that makes sense. Rule 2.
Have a specific basis. Your prediction shouldn't be a random guess. Why do you think costs will rise? Is it based on historical inflation data? Is it a known fact like a planned fee hike at a school? You need a basis, a reason for the number you're using.
Got it. No pulling numbers out of thin air. Rule 3.
Consider evolving conditions. Things change constantly. Interest rates go up and down. The economy booms or busts. Your forecast must be able to adapt. You can't use assumptions from 2010 to build a plan in 2026.
Okay. Rule 4.
Look closely at your assumptions. This is critical. If your entire retirement plan is based on the assumption that your salary will grow at 10% per year, but your industry is crashing and layoffs are happening, you need to change that assumption immediately. The forecast is only as good as its underlying assumptions.
Right. Garbage in, garbage out.
Precisely. Rule 5 is use expert opinions. You need to look at macro factors. What are professional economists saying about inflation? What is the central bank's stance on interest rates? You don't have to be an economist yourself, but you should definitely listen to them.
Okay, and the last one, Rule 6.
Rely on experience. This is where a good advisor really adds value. You know from experience how things usually work in the real world. You know that a home renovation always ends up costing 20% more than the initial quote. You know that medical costs rise much faster than general inflation. You use that practical experience to build a buffer into the forecast.
So it sounds like forecasting is less about being a psychic and more about being a detective, piecing together clues.
Exactly. It's about building a reasonable, defensible model of the future based on data, not on hope.
Which leads us perfectly into section 3.5, monitoring budgets and savings provision, because a model is completely useless if you don't check it against reality.
The text uses a great term for this. It calls it continuous variance analysis.
That sounds fancy. Is it just a fancy way of saying, did I spend what I said I would spend?
Pretty much. The example given in the text is conveyance, or your transportation costs. Let's say you budgeted 4,000 rupees for the month, but for the last 3 months, you've actually spent 6,000. You have a variance of negative 2,000.
Okay, so I'm overspending. What do I do?
Variance analysis says you have 2 choices. Action A is to cut the usage. You stop taking Ubers everywhere and start taking the bus. You bring your actual spending down to match the budget.
And action B.
Action B is to admit that your budget was wrong. Maybe fuel prices went up or your commute changed. So you raise the budget figure to 6,000. But, and this is the key, if you raise one expense budget, you have to find that 2,000 from somewhere else.
You have to cut savings or cut spending in another category.
Exactly. You can't just ignore it. The math has to balance. The budget has to be a closed loop.
Right. And speaking of savings, the text then lists 5 specific ways to raise your savings level. This feels like a great checklist for any client meeting.
It is. It's the action plan. Yeah. So, number 1 is target percentage. You set a specific target like, I will save 10% of my income, and you stick to it no matter what the amount is.
So it scales with your income.
It does. Number 2 is target amount. This is saying, I need to save 20,000 rupees a month, a fixed number. This is really good for goal-based planning where you know you need a specific amount by a certain date.
Okay. Number 3.
Cut waste. This is the low-hanging fruit. Go through your expenses and eliminate wasteful expenditure and discretionary spending you don't really care about.
Like those gym memberships we never use.
Exactly. Number 4 is about windfalls. This is a big one. You direct any lump sum receipts, like a bonus from work or a tax refund, directly into savings. Don't let it touch your regular checking account where it can get spent.
That's the hardest one, I think. You get that bonus, and your first thought is, I deserve a treat.
And you do, but maybe a small treat. The text's advice is to save the bulk of the windfall. And finally, number 5, higher income. If you get a raise, do not let your lifestyle creep up to match it. Save the entire increment. If you were living comfortably on $50K before, and now you earn $60K, save that extra $10K before you even get used to it.
Lifestyle creep is so real. You get a raise, and suddenly you feel like you need a better car or better clothes.
It's the silent killer of wealth accumulation.
All right, we are about halfway through the chapter now. Let's shift gears a bit. Section 3.6, Personal Balance Sheet and Net Worth. We've been talking about income and expenses, which is a flow of money over time. How is this different?
A balance sheet is a snapshot. It is your financial position at a particular date. Imagine freezing time at midnight on March 31st. What do you own and what do you owe at that exact moment? It doesn't matter what you earned last month. It matters what you have today.
Okay, so it's made up of assets and liabilities. The text breaks assets down into 2 main types, physical versus financial.
Right. So your physical assets are things like real estate, gold, things you can touch. The pros are that they're often a good hedge against inflation, and they're tangible. Indians, in particular, love assets they can see and feel.
And the cons?
The cons are that they're illiquid. It's hard to sell a house quickly. There's often a lack of regulation, and the ticket size is very large. You can't just buy 500 rupees worth of a house.
Right, and financial assets.
Financial assets are your stocks, bonds, FDs, mutual funds. The pros here are the opposite. They offer liquidity, they're standardized, they're heavily regulated, and you can buy them in very small amounts.
And within those assets, we also classify them as either growth-oriented or income-oriented.
Correct. A rental property might be both. You get rent, which is income, and you hope the price appreciates, which is growth. Gold is purely a growth asset. It doesn't pay any dividends. A bond is primarily an income-oriented asset.
Then on the other side of the balance sheet, we have liabilities, pretty straightforward, loans, credit card dues. The text uses the term leveraging.
Leveraging just means using loans or borrowed money to buy assets. The most common example is taking a mortgage to buy a house. It magnifies your potential returns, but it also adds what the text calls volatility risk. If the asset price drops, you still owe the full loan amount.
Okay. And the magic formula that ties it all together is net worth.
Yes. The formula is simply total assets minus total liabilities equals net worth.
The text gives us the example of a person named Lakshmi. Let's use her numbers to visualize it.
Sure. Lakshmi has total assets of 36.22 lakhs. This includes her house, her car, and all her investments.
Okay.
She has total liabilities of 12.07 lakhs. That's her home loan and some credit card debt.
Right.
So you take 36.22 lakhs, subtract 12.07 lakhs, and you get her net worth, which is 24.15 lakhs.
So visualizing that is helpful. It's basically, if I sold everything I own today and paid off every single one of my debts, what would be left in my pocket?
That is exactly what net worth is. It's the number that actually truly belongs to you.
Okay, perfect. Section 3.7, creating a budget and savings plan. The text lists a 7-step process here, labeled A through G. Let's run through this as a checklist.
Okay, step A is gather details. Get every single scrap of paper related to income and expenses, bank statements, salary slips, bills, everything. Check for misses. Did you forget about the annual car insurance payment or the quarterly society maintenance bill? The non-monthly expenses are the ones that are easiest to forget and they can wreck a budget.
Good point. Step C.
Basis, use actual past expenses if you can. Don't just guess what you spend on groceries. Go through your bank statements. Record keeping is your friend here.
Step D is adjust for changes. This seems important.
It is. Expand on that.
Well, if you know that vegetable prices are spiking because of inflation, your grocery bills from 6 months ago are irrelevant. Or if it's October and you know Diwali is coming up, you have to budget for higher expenses. You have to adjust the budget for the specific conditions of the upcoming period.
Right. It's not a static document.
Exactly. Step E.
Contingency feature. Build a small buffer into your budget for sudden minor disruptions. Not an emergency fund, but just a little wiggle room.
Okay. Step.
Goal alignment. This is the big sanity check. Does the savings figure you ended up with actually match what you need to save for your goals? If your goal requires you to save $50,000 a month, but your budget only allows for $20,000, you have a problem. You have to go back to the beginning.
And finally, step G.
Allocation. Direct the savings to your investments automatically. Set up SIPs. Use a systematic approach. Don't just wait to save whatever is left at the end of the month. Pay yourself first.
I really like step D. Adjust for changes. It reminds us that a budget isn't a stone tablet you write once. It has to breathe and change with your life.
Absolutely. A budget is a living document.
Now let's get a little dark for a moment. Section 3.8. Contingency planning. The text outlines 5 specific risks we need to plan for.
It's the advisor's job. Risk number 1 is the most obvious. Death of an earner.
The risk to dependence is huge.
And the solution is clear. Life insurance.
Okay, risk 2.
Health issues. Medical costs in India can wipe out a lifetime of savings in a matter of days.
Yeah.
The solution. Medical insurance.
Risk.
Job loss. This is a double blow. Not only does your income stop, but searching for a new job actually costs money. You might need to travel for interviews, get certifications.
Right.
The solution here is the emergency fund.
The text mentions a laddered way to hold this fund. What exactly does that mean?
It means you don't keep the entire emergency fund in a savings account, earning a measly 3%. You keep some of it, say 1 month's worth of expenses, in highly liquid assets like cash or your savings account for immediate access.
Okay.
You keep the rest in slightly less liquid but higher return instruments like a short-term fixed deposit or a liquid mutual fund. You can break these if the emergency drags on for months, and you must review this fund size annually or whenever your EMIs change.
Got it. Okay. Risk number 4 is an interesting one.
Separation or divorce.
Yes. The text notes that in developed countries, wealthy people often use prenuptial agreements, but then it gives a giant exam flag for the Indian context.
This is a critical one to remember.
What's the flag?
The text explicitly states, and I'm quoting, "The legality of prenuptial agreements in India has not been established." You need to know that sentence verbatim. You cannot legally rely on a prenup in India the way you might be able to in the US or Europe.
Wow. That is a crucial detail for any advisor working in India. You can't just copy-paste strategies from the West.
Exactly. It means asset protection during a marital dispute has to be handled very differently here, perhaps through trusts or specific ownership structures, because a simple contract between spouses might not hold up in court.
Okay. And the final risk, risk 5.
Asset ownership structure. This is about what happens if you pass away. How hard is it for your family to access the assets you've left for them? The solution is joint holding. Bank accounts should be held jointly. Loans for property should have joint borrowers. It simplifies the transmission of assets enormously.
Okay, friends, take a deep breath, shake out your hands. We have arrived at the final boss level of this chapter, section 3.9, financial ratios.
The math section, don't be scared.
The text says, just as analysts use ratios for companies, we use them for individuals. There are 10 specific items and ratios listed here. We are going to go through them one by one. I want the definition, the formula, and the benchmark if there is one. No skipping.
Let's do it. It's just simple division.
Right. 3.9.1 savings ratio.
The formula is savings per year divided by your annual income.
Right.
Let's use the example of XYZ from the text. Their income is $10,000 from salary plus $200 from interest, so $10,200 total income.
And the savings.
Remember our rule from earlier? It's net salary plus your PF contributions minus all your expenses. In the example, their total savings came out to be $3,200.
Okay.
So the calculation is $3,200 divided by $10,200, which equals 31.4%.
That feels like a pretty healthy savings rate. Is there a long-term benchmark we should know?
Yes. The text mentions the accumulated savings to income ratio. This is your total accumulated investments divided by your current annual income.
And the benchmark.
By your early 40s, this ratio should be about 3 times your annual income. So if you earn 10 lakhs a year, you should have about 30 lakhs in investments by the time you're 40. It's a good rule of thumb.
Okay. 3.9.2 and 3.9.3 are just definitions. Total assets, physical plus financial, and total liabilities, all debts. That's easy enough. Let's jump to 3.9.4, leverage ratio.
This measures your debt load, how much your life is funded by borrowing. The formula is total liabilities divided by total assets.
Okay.
The example is assets are 65 lakhs. Liabilities are 13 lakhs. So you do 13 divided by 65, which equals 0.2 or 20%.
And there's a really important exam flag here.
A critical one. If this ratio is greater than 1 or 100%,
Oh.
it means you are technically insolvent. Your assets are not enough to pay off all your debts. You are, in simple terms, bankrupt.
Okay. 3.9.5 is net worth, which we already covered is just assets minus liabilities. So 3.9.6 is the solvency ratio.
Right. And this is just the inverse of the leverage ratio. The formula is net worth divided by total assets.
So using the same numbers.
The net worth was 52 lakhs, 65 minus 13. The assets were 65 lakhs. So 52 divided by 65 equals 0.8 or 80%. Basically, it means 80% of your assets are truly yours and the other 20% belongs to the bank. That's your leverage.
Right. Now, 3.9.7, liquid assets. This seems simple on the surface, but I feel like there is a trap hidden in this definition.
There's a huge trap here. You have to listen carefully. Liquid assets include cash, money in your savings accounts, fixed deposits, FDs that mature in less than 6 months, and liquid mutual funds.
Okay, what is excluded? Flag this.
What is excluded is stocks or shares and closed-end mutual funds.
Wait, why? I can sell my Reliance shares in literally 2 minutes on my phone. Why aren't they considered liquid for this ratio?
Because they are volatile. Liquidity, in the context of financial planning, implies that you can get your cash out without a significant loss of value. If the stock market crashes 10% tomorrow and you're forced to sell, you lose a big chunk of value. So for the purpose of these safety ratios, stocks are not considered liquid assets because you might be forced to sell them at a loss.
Okay, that's a key distinction. No stocks in liquid assets.
Exactly.
Which brings us to 3.9.8, the liquidity ratio.
The formula here is liquid assets divided by your monthly expenses. This tells you, very simply, how many months you could survive if your income dropped to 0 tomorrow.
And what's a good benchmark?
The text says 4 to 6 months of expenses is a comfortable buffer.
And the example.
The example of NFG shows they have liquid assets of 13 lakhs and monthly expenses of 1.5 lakhs. So you divide 13 by 1.5 and you get 8.66 months. This client is very comfortable. They have a massive safety buffer.
Okay, almost there. 3.9.9, financial assets ratio.
The formula is financial assets divided by total assets.
And the example.
The example of PQR shows financial assets of 27 lakhs and total assets of 50 lakhs. The ratio is therefore 54%. The insight here is that you generally want this ratio to be higher as your financial goals get closer. You don't want to be in a position where you have to sell a house, which is a physical asset, to pay for a college fee that's due next year. You need liquid financial assets for that.
That makes a lot of sense. And finally, 3.9.10, the debt-to-income ratio. This is a big one that anyone applying for a loan hears about.
Yes. The banks look at this very closely. The formula is your total monthly debt servicing commitment divided by your monthly income. In simple terms, it's your total EMIs for the month divided by your salary.
Okay.
The example is total debt payments are $60,000. Monthly income is $1,050,000. So the ratio is 60 divided by 150, which is 40%.
And what's the benchmark here? This is another exam flag, right?
Definitely. A ratio higher than 35 to 40% is generally seen as excessive by lenders. If you are spending more than 40% of your income just on EMIs, you are in the danger zone. Banks might be hesitant to give you another loan.
Phew. Okay. That was a lot of math, but breaking it down formula by formula really helps. It's not so scary. It's really just about measuring the vital signs of a person's financial health.
And notice how the whole chapter flows.
Yeah.
It starts with the why, cash flow empowers you. It moves to the how, budgeting and balance sheets.
Yeah.
And it ends with the measurement, the ratios to see if you're on track. It's a complete system.
It really is. Okay, before we sign off, what is the one final exam tip you want to leave our student listeners with from this chapter? The one thing they absolutely cannot forget.
It comes down to 2 definitions we've hammered on. You have to watch out for the components of liquid assets and savings. Remember, 1, liquid assets does not include stocks.
Right.
And 2, your total savings calculation does include your PF and other mandatory contributions. If you mix those 2 definitions up, you will get the ratio calculations wrong every single time.
That's a great tip. And here's a provocative thought to end on, something to mull over. We mentioned that prenuptial agreements are not legally established in India.
Yes, a very important point.
So, if you are an investment advisor dealing with a high net worth client today, and they come to you worried about protecting their family assets from a potential marital discord, what do you actually do? You can't just tell them to write a prenup.
You can't.
You have to get creative. You have to rely on different asset structures, trusts, joint holdings with parents, maybe gifting assets before marriage. It pushes the boundaries of standard financial planning into the realm of legal strategy.
Mhm.
It's a powerful reminder that our job is never just about the numbers. It's about navigating the complexities of law and human relationships.
Absolutely. It's what makes this profession so challenging and so fascinating.
That's it for this deep dive on cash flow and budgeting. Good luck with your NESM prep, everyone. We'll catch you in the next chapter.
Keep calculating, keep planning. Happy studying.